Lectures on Accounting, Lecture 2B, Branches of Accounting, Financial Accounting, Cost Accounting, Management Accounting. Dear students, today let us learn about various branches of accounting. The branches of accounting are Financial Accounting, Cost Accounting, and Management Accounting. Introduction. Accounting. Accounting is a wider term and includes recording, classifying, and summarizing of business transactions in terms of money, preparation of financial reports, and analysis and interpretation of these reports for the information and guidance of management. The business accounting system consists of three parts: financial accounting, cost accounting, management accounting. Financial accounting. Financial accounting may be defined as the science and art of systematically recording, classifying, and summarizing business transactions of financial character, and finally interpreting the results for determining the financial profit or loss at the end of an accounting year. It also shows the financial position of the firm and thus records and reports financial statements, balance sheet, income statement, and statement of cash flows. Cost accounting. Cost accounting is that branch of accounting information system which records, measures, and reports information about costs. The primary purpose of cost accounting is cost ascertainment and its use in decision making and performance evaluation. Cost accounting meaning. Cost accounting is concerned with recording, classifying, and appropriate allocation of expenditure for the determination of the cost of production services and for the suitably arranged data for purposes of control and guidance of information to management for decision making. Cost means the price paid for something. Cost ascertainment is computation of actual costs incurred. Cost estimation is process of predetermining costs of goods and services. Objectives. Objectives of cost accounting: estimation of costs, ascertainments of costs, cost control, cost reduction, determining selling price, facilitating preparation of financial and other statements, providing basis for operating policy. Elements of cost: material, labor, expenses. Under materials, direct and indirect materials are there. Under labor, direct and indirect labor are there. Under expenses, direct and indirect expenses are there. Indirect material, indirect labor, indirect expenses are known as overheads. Overheads consists of production or work overheads, administration overheads, selling and distribution overheads. Material. The substance from which the finished product is made is known as material. A. Direct material is one which can be directly or easily identified in the product. Example: timber in furniture, cloth in dress, etc. B. Indirect material, one which cannot be easily identified in the product. Example: disposable safety equipment, disposable tools, glue, tape, oil, etc. Labor. The human effort required to convert the materials into finished product is called labor. A. Direct labor is one which can be conveniently identified or attributed wholly to a particular job, product, or process. Example: wages paid to carpenter, fees paid to tailor, etc. B. Indirect labor is one which cannot be conveniently identified or attributed wholly to a particular job, product, or process. Examples of indirect labor: at factory level, foreman's salary, work manager's salary, gatekeeper's salary, etc. At office level, accountant's salary, general manager's salary, manager's salary, etc. At selling and distribution level, salesman's salaries, logistic manager's salary, etc. Other expenses are those expenses other than materials and labor. Direct expenses are those expenses which can be directly allocated to a particular job, process, or product. Example: excise duty, royalty, special hire charges, etc. Indirect expenses are those expenses which cannot be directly allocated to a particular job, process, or product. Examples of other expenses: at factory level, factory rent, factory insurance, lighting, etc. At office level, office rent, office insurance, office lighting, etc. At sales and distribution level, advertising, showroom expenses like rent, insurance, etc. Fixed variable and semi-variable costs. Fixed costs, expenses that do not alter in the short run in relation to changes in output. Example, rent, insurance and depreciation. These costs are linked to time rather than the level of business activity. Variable costs, expenses that alter in the short run to changes in output. Examples are raw material, packaging and components. They are payments for the use of inputs. Semi-variable costs, expenses that vary with output but not in direct proportion. Example, maintenance costs. They often comprise a fixed element and a variable element. Direct and indirect costs. Direct costs, costs that can be directly identified with a product or cost center. They are mainly variable costs but can include some fixed costs. Example, the rent of a building solely used for one product. They are also referred to as prime costs. Indirect costs. Indirect costs that cannot be allocated accurately to a cost center or product. Example, administration costs, management salaries or maintenance costs. Another term for this is overheads. Management accounting. Meaning, management accounting involves furnishing of the accounting data to the management in such a way that it facilitates the decision making and improve the efficiency within the organization and finally helps in achieving the goals of the organization. Definitions. Management accounting. According to American Accounting Association, management accounting includes methods and concepts necessary for control through the evaluation and interpretation of performances. According to Robert N. Anthony, management accounting is concerned with accounting information that is useful to the management. Objectives of management accounting: helpful in planning and policy information, forecasting, setting goals, forming policies on the basis of available information, help in decision making, makes decision cost, price, profit and savings, helpful in controlling. Management accounting devices like standard costing and budgetary control are helpful in controlling performances. Motivation to employee: delegation increase the job satisfaction of employee and encourage them to look forward. Provides accounting information to management. Management accounting versus financial accounting. Dimension: management accounting, financial accounting. Structure varies according to information, whereas in financial accounting, unified structure is there. Dimension: source of principle. Whatever is useful to management is the source of information for management accounting. Generally accepted accounting principles are the source of principle for financial accounting. Need is optional as per management accounting. Need is a statutory obligation for financial accounting. Time of orientation. As for management accounting, it is historical and estimates of the future. As for financial accounting, it is purely historical. Report entity. As per management accounting, responsibility centers. As per financial accounting, overall organization. 6. The purpose as per management accounting is a means to the end of assisting management. As for financial management, external reporting, statements for outside, etc. Users. As per management accounting, users are relatively small group, known identity. For financial accounting, relatively large group, mostly unknown. Information. Content. As per management accounting, monetary and non-monetary. As per financial accounting, it is primarily monetary. Information decision. 9. Information procession. As for management accounting, it is many approximations. As for financial accounting, few approximations. Report frequency. As for management accounting, varies with purpose, monthly or weekly. It is, as for financial accounting, quarterly and annually. Report timelines. Report is used promptly after the end of the period covered by as per management auditing, management accounting, and as for financial accounting, delay of weeks or even months. Liability potential. As per management accounting, management will take action. As per financial accounting, legally punishable. Recap. Thanks for watching. Please subscribe to our YouTube channel Accounts Lobby for various solved problems and lectures on accountancy.